All right. So this one is going to be kind of specifically chapter one. Okay. Which it kind of overlaps with that intro to financial accounting video that I already recorded for you. But I don't know, there were some things that I kind of missed in that one. So I'll go through this pretty quick. Okay. So it's the language of business accounting. It's how we analyze and record business transactions. It's how we communicate business transactions and specifically to outside parties, investors and creditors. Okay. So that's kind of what the other video was mainly focused on. So business. A lot of you, I think, actually have aspirations to own your own business. The idea of being your own boss, or you guys have lots of cool ideas oftentimes. And so you'd be able to develop that idea, monetize it, make lots of money, kind of have freedom, the ability to um, generate money and spend time how you want to spend it, stuff like that. Okay. Uh, so a business exists to provide goods or services, right? Many businesses nowadays are service-based businesses, but there are still a lot of businesses that provide goods, manufacture goods. So basically three broad areas or types of businesses. So manufacturing businesses, they take raw materials or unfinished goods and some way they finish them, make them into a product. Okay, so that's manufacturing. Merchandising is where we take goods that are already finished and we either retail them, which would be selling them directly to consumers, or we sell them to other businesses. And we call that wholesale or B2B type business. So, your retail could be an Amazon business or an Etsy business or something like that. Your wholesale business could be, I don't know, all kinds of wholesale businesses, right? You could, I know one guy that grew flowers and then he sold them to greenhouses, and then the greenhouse, um, the nursery sold it to uh, retail customers. Okay. And then service industry, like I said, a lot of businesses are service based now in our economy. So that's mowing lawns or cutting hair or working as a lawyer or an accountant, um, or something like that. Now, obviously, a business could be kind of a mix of these things too, right? So, like a restaurant, you are taking a lot of raw materials, food, kind of processing it into something that you retail. You're also providing a service um, with your um, waiters and waitresses serving the food, stuff like that. So, anyways, but basic types of businesses. Again, this isn't like heavily tested. It's just terminology that you need to know. Okay. All right. So legal structures of businesses, a sole proprietorship. Maybe you've already kind of done that a little bit in your life where you just start selling things or you start doing work for people and they pay you. That's kind of a sole proprietorship. Okay. A partnership would be if you are partnered up with someone or multiple people and you guys are out mowing lawns um, or doing whatever. That's a partnership. Okay. But basically, with those two, the individual isn't really distinct from the business. Okay. That they're one and the same. And I would warn you against, especially at this point, now that you guys are in college, to form an LLC is so easy in states. Like you can go online, doesn't cost very much money. Don't use, I wouldn't recommend using a lawyer or anything like that. I would just go on to the state's website, their corporation's website, make sure you're actually in the state one, the .gov, because there are a lot of companies that are trying to kind of trick you into using their services to form an LLC. But anyways, here in Missouri, super straightforward. Just go into MissouriCorporations.gov or something like that, and create an LLC. What an LLC does, or a corporation, both of these provide a legal protection, right? It separates the business from you individually. And so let's say you own a car and I mean, most likely you guys don't own a house, but let's just pretend you own a house and you have some money in a bank account. And then you form a business. And if it's a sole proprietorship, and then let's just say you're out doing deliveries or something like that, and um, you cause an accident or something like that. Well, technically, the people who you injured or are harmed or whatever, they could go after not only you, like the business that you'd kind of formed, but they could also go after your personal assets. Whereas with a limited liability company or a corporation, it's separate, and so they could sue the business, possibly take the assets of the business, but your personal, let's say your personal car that's separate from the business, or your house, or your personal bank account, that would be protected. Okay, so LLC, super simple. It doesn't impact like your taxes. You can still, there's still free tax preparation software and stuff like that you can still use. So it doesn't, not a huge deal. Now, in this class, we focus on corporations, and primarily we focus on publicly traded corporations. So that's your big companies. I think I'm repeating myself with this, but the reason we do that is because they have to publish their financial information quarterly here in the United States. And so they have to follow these rules that I'm going to teach you in this class. The accounting standards that are here in the United States. And so because they have to adhere to those rules, those are the rules that we teach. And that's just the basics of financial accounting, bottom line. Okay. But with a corporation, like I already said, separate legal entity, that's what also provides limited liability to the owners of the company, which are also called the stockholders or the shareholders. The ownership and management can be separate in a corporation. They can also be, there can be overlap there. If you're like the founder of the business, you also may manage the business. But, you know, with big corporations, oftentimes it's separate. So like, I don't know, let's think Walmart. Walmart was founded by Sam Walton. He has passed away now, but the Walton family still has significant ownership in the company. However, they don't manage the business day to day. There's an outside non-Walton CEO that runs the day-to-day business. Okay. Something similar with Apple, but like a different one would be like NVIDIA. NVIDIA, the founder of the company, is still running it, Jensen Huang. And so he has ownership. You can also have ownership though, but he also is in the day-to-day management because he's the CEO. With a corporation, your basic corporation, a C corporation, it pays taxes separately from the corporation. Whereas an LLC is a pass-through entity. So that's why I was saying it won't really impact your taxes that much. But you can also elect to do an S corporation, which is a pass-through entity. So anyways, but a corporation is a separate legal entity, and so it is taxed separately unless you change up the filing status for it. And then the corporation does have specific government regulation that it has to adhere to. Same with a limited liability company. That's, you're forming it with the state. It has legal standing with the state. Okay. So again, this is more just a conversation, not necessarily test a lot, but what's necessary to start a business. You need an idea, right? Something that you that people need or they want, that they're willing to buy from you, or a service that you can provide for profit. Oftentimes you need capital, some resources to get started, and then management skill. You need to be able to put those resources to work and actually make money. So I don't know, this stage in your life, probably you have more ideas than you do capital. Um, and you're getting management skill as you do different things. I would strongly encourage you to start to put some of those ideas into practice. Don't just think like, oh, if I just had money, then I'd be able to do this idea or that idea. But instead, just try ideas that don't really require very much money, little things, and see if you can can actually generate income with those little ideas. So, but because we're, this isn't an entrepreneurship class, we're focused more on financial accounting. So where do you get the capital from? And there's two sources, either from debt financing, okay, which means that you borrow the money from someone, okay, which the more formal channel is lenders like banks, financial institutions. If you're going to borrow money from them, they're going to want financial information on the business, right? Or the other more formal channel would be equity financing, which that would be investors that believe in you, believe in your business, and they want some ownership in the business. And that's called equity financing. Again, if it's a business that, I guess if you're going for significant financing, those investors, they should want to see financial information on the business. They should want to see financial statements instead of just giving you money. Okay. Debt financing, it has to be repaid. Okay. And normally there's like a specific time when it needs to be paid, and it's repaid with interest, right? Interest is the cost of using someone else's money. Okay. If you don't repay debts, then typically there is recourse. So a bank can force you into foreclosure or force you to liquidate your assets or something like that. And then the other thing is that oftentimes debt financing is just difficult to qualify for, right? Banks want to see a track record of success. They want to see that you can, their banks are very risk adverse, right? And so they want to see and almost guarantee that you can pay back the loan, which is challenging to demonstrate if you're just starting a business. I've heard people say a bank will only loan you money if you really don't need it. If you need it, you're too risky. If you don't need the money, then they're willing to loan it to you. But again, in those cases, you don't end up needing it. Equity financing. Okay, so here we're giving up ownership in the business, right? So we're giving up shares of stock. And those shares of stock normally give the people who hold the stock, that gives them the right to vote, gives them the right to share in the profits of the business. And if the business is terminated, then any assets minus the liabilities, whatever's left over there, would go back to the owners. And that's what we call the equity of the business. Okay. Now, an important thing with this is equity doesn't guarantee that you'll be repaid, right? Whereas debt financing, typically there are legally binding contracts that say, that you have to pay back that person who financed you. Whereas with equity, it's just if there's leftover money from the business that goes back. Now, if the business is profitable, then obviously the owners of the business, they want to share in those profits, and the owners get to decide by voting how the business disperses its money. Okay. And so, but if it just goes under or liquidates, there's no guarantee. There's no future date. Some businesses pay dividends, other businesses don't. It's one of those things. the owners ultimately decide. And with big businesses, like, if you invest in Nvidia, you're like one of literally millions of shareholders. And so your vote isn't really going to mean that much, right? But equity financing is also permanent. Like once you buy that share of stock, you can hold it indefinitely. You can pass it on to your kids or friends or whoever. Basically, that ownership remains. Okay. Oops. Okay. So, how do we share in the the profits and losses of the business? The business may decide to pay dividends. So if it has excess cash, and the business doesn't necessarily know where to invest that cash, or it doesn't feel like it'll get a good return on that money, it can decide to pay a dividend, which is just a disbursement to the owners, a disbursement of cash. Okay. It is not an expense for the business. It's the business choosing to give money to the owners. Okay. And then the other way you can make money is if the value of the stock goes up, right? So if you buy a share of stock for $100 and then 6 months later it's worth $150, if you sell that stock, you've just created a capital gain of $50. And so that's another way that the investors can make money on an investment. So, like I said, in a more formal setting, with investors who are, I would say, educated, the terminology that the Securities Exchange Commission uses is sophisticated investors. They're going to want information before they're willing to give the business money. Okay. And so that's where financial accounting comes into play. Okay. And so kind of three different types of activities that go on in a business. Operating activities, that's just like the day-to-day. That's the product or the service that you're providing, right? And you're receiving cash for that. Financing activities is either that debt financing or equity financing that the business enters into to have the capital necessary to do the operating activities. And then if the business has extra money, then it can invest in equipment, it can invest in other businesses, all types of things, basically, or it can distribute the money back to the investors. So you can see the money can flow a lot of different ways. Okay, so I already mentioned this organization here, the Securities and Exchange Commission, the SEC. That is a U.S. governmental agency established by Congress, and it sets the rules for our financial markets here in the United States. Okay, the FASB, or the Financial Accounting Standards Board, it was given authority, actually the SEC granted it authority, and it's a not-for-profit organization that was created to develop accounting standards. Okay, so basically it creates the accounting standards, the US GAAP, we call it, or generally accepted accounting principles. So the FASB creates those accounting rules. The SEC is who gives the FASB authority, but the SEC also enforces the rules. Okay, so if a company starts to break, if a publicly traded company or a company that falls under the SEC regulations, if it starts to break the rules, the SEC is actually the one who enforces GAAP. Okay, and we find GAAP, the accounting standards, we find that within the accounting standards codification. Okay, so again, you don't need to have this stuff memorized word for word, but just kind of know, Like, okay, the SEC has authority from Congress to govern financial markets. The FASB has authority from the SEC to develop accounting standards. We call those accounting standards generally accepted accounting principles, GAAP. Okay, I've showed you the accounting equation quickly. This is basically any kind of transaction, any type of financial event that happens to a business, or any kind of economic event that happens to a business. We can capture that event in the accounting equation. Okay, so as the assets of the business are the resources, the liabilities are the claims on our resources, or like our obligations to other entities or other people, and then the equity is what is left over. Okay, and so there are two ways to increase equity. Okay, and I'll go into this more. This is like really the meat of it. It'll kind of be in the next chapter, but this is the meat of what you need to know, and what you'll be doing a lot of is just knowing what impacts the assets of the business, what type of transaction impacts the liabilities, and then how do you increase equity in a business and how do you decrease equity in business. Okay, so the two ways to increase equity would be through one way would be through issuing common stock. Okay, so equity financing that increases the equity in a business, and then also through revenue. Okay, so revenue is the idea of earning or increasing our assets or decreasing our liabilities in some way. So that increases equity. So common stock increases equity, which we can also call capital contributions, or revenue increases equity. And then two ways to decrease equity. One would be through paying a dividend. Okay, so that reduces our cash, and that reduces the equity of the business. Or the other is through an expense. An expense is part of the day-to-day business's obligations, like the current the expenses that we incur in our day-to-day operations. Okay, like I said, I'll do more on this because basically a lot of what we're going to do is analyze how transactions impact this equation. Okay, financial statements. In this class, we're really just focused on the balance sheet, the income statement, statement of stockholders' equity or shareholders' equity, and statement of cash flow. So in this class, we're really just focused on 4 financial statements. Okay, the balance sheet is simply the accounting equation. Okay, it's the assets of the business on a date. So on December 31st, 2020, here are the balances of our assets. Our liabilities, remember those are the obligations of the business, and then also the stockholders' equity, or just equity for short, or shareholders' equity. It's all synonyms. Okay, and so you can see common stock increases equity. Retained earnings is simply the revenue minus the expenses plus whatever was retained from the last period. That's why it's called retained earnings. And yeah, so, and then the equation, an important thing to notice is it is an actual equation. So if your assets increase, something on this side of the equation needs to also increase in order to get it to continue to equal. Or if your assets increase, some other type of asset could decrease. Okay, but the equation always has to balance. And so you'll notice here in the balance sheet, our total assets equal our total liabilities and stockholders' equity. They have to balance. Okay. There you go. Okay. Income statement. And you'll notice we have revenue. Remember, that was one of the ways we increase equity. And then we have expenses. And that's one of the ways we decrease equity. Okay. There's really just the 2 broad categories. Now, there are different types of revenues that we'll learn about, and there are different types of expenses. but there's really just the two broad categories, revenues and expenses. Your revenues minus your expenses give you net income. And this is for a period of time, whereas the balance sheet is just for one moment in time, like a specific time, December 31st. The income statement is for a full period. So you'll see it's for the year ended December 31st, 2020. So this is for all of 2020. Okay. Stockholders' equity. Okay. This is how you get that retained earnings number. Okay. The retained earnings number that's in the balance sheet. And so if you look, we have, and I don't, this is a little more complicated than what you really need. Basically, if we just look at this part here, you have your beginning balance. That's from December 31st, 2019, which would be the same as January 1st, 2020. So that's your beginning balance. Then you take net income and then you subtract off your dividends. And that gives you your ending retained earnings. Okay. So just focus on that part of the statement of stockholders' equity, or a statement of retained earnings means the same thing. Okay. Really, right there is showing it. So beginning retained earnings, add net income, subtract dividends, gives you your ending retained earnings. Okay. And then statement of cash flows. Cash is so important for a business. It's like people reference it as, or refer to it kind of as like the oil, like on your car engine. If you have a car, if you don't keep oil in the engine will go bad, right? It'll get ruined. And so cash is like the oil to the business. It keeps everything flowing in the business, keeps it working. And so in your balance sheet, you show, jump back there real quick. You show a cash balance, okay? And so that's on December 31st. Oftentimes it's a comparative balance sheet. So it'll actually show the cash balance on December 31st, in this case, it'd be 2019. So you have two cash balances, but we don't really know like why our cash increased or why our cash decreased or what we spent cash on. And so that's what the statement of cash flows does. It shows us right here. Okay. So it shows us, and actually it goes into more detail than this, but basically it just shows the cash that we receive from our operations. Remember, that's the day-to-day business. It shows us the cash, in this case, cash we used for investing. So that would be like buying equipment, buying property, investing in other companies, and then also the cash, in this case, the cash flows from investing. So it's an outflow. So like that would be it would increase if we issued common stock, or if we borrowed money, or a decrease if we paid those things back. So that's your statement of cash flows. Okay, and then this is important, kind of a small, I guess on your screen it's bigger. Sorry, got multiple screens, and so it doesn't work real great. I'm using my pointer, but you guys can't see it. Anyway, I'm going to look this way a little bit so you can see my pointer. Okay. So we always prepare our income statement first, right? Revenues minus expenses, that gives us net income. That number there goes into the statement of stockholders' equity, or just the statement of retained earnings. Okay. And so we have our beginning balance of retained earnings plus our net income minus our dividends give us our ending balance. Okay. And then that number flows into the balance sheet, and it's in this retained earnings number. Okay. So see how that's the exact same right there. So our beginning balance plus our net income minus, it looks like they purchased stock or repurchased stock. Okay. And then paid dividends. So, but to just simplify it, it'll be the beginning balance plus net income minus dividends. And that will be the retained earnings number that's in your balance sheet. So you kind of, or you do have to prepare them in order. So you do your income statement first and your statement of retained earnings, and then your balance sheet. Okay. And we'll get more into that, but that's the relationship. Okay. Other things that need to be provided are notes to the financial statements. And that is required by US GAAP. The notes really are like the terminology they use is an integral part of the financial reporting. An auditor's report, publicly traded companies, or not even, it doesn't even have to be publicly traded companies, but a lot of companies have an independent auditor, an external auditor that provides an opinion on the financial statements. And then another part that's required is management discussion and analysis. And that's basically an overview provided by management about the company, its strengths and weaknesses, its opportunities. Oftentimes it's forward looking. So that's chapter 1. You'll be able to see how this will actually be tested, this information, when you look at the study guide for exam 1. You'll see that this really isn't covered that much, but I appreciate you watching, and have a good day.